All right, let's jump straight in. Welcome to The Explainer. Today, we are taking a magnifying glass to one of the absolute most puzzling financial reports of the year so far. We're talking about Acadia Pharmaceuticals' Q1 2026 earnings. Now, if you follow the biopharma sector, you already know Acadia. They're a heavyweight in central nervous system therapeutics, the team behind some major breakthrough treatments for Parkinson's disease psychosis and Rett syndrome. But man, their recent Q1 numbers have left the market completely scratching its head. On one hand, we're seeing record sales, but on the other, a sudden and massive drop in net income. If you're an investor or honestly just a biotech watcher, this is exactly the kind of mystery we love to decode. So today, relying entirely on their latest SEC filings, market data, and analyst reports, we're going to figure out how a company with an absolute stranglehold in a niche market suddenly faces an earnings shock.
Okay, let's dive into this. Here is our roadmap for The Explainer. We'll logically step from the Q1 2026 earnings shock to diving into the financials, then the twin product pillars, followed by the competitive landscape, and wrap up with the long-term macro outlook.
Section 1. Q1 2026 earnings shock. A sudden drop in net income. Now, the stark reality of Q1 2026 for Acadia really boils down to this one number, $3.6 million. That's their reported net income for the entire quarter. And to understand why this caused such a massive stir, you really have to look back exactly 1 year. In the first quarter of 2025, Acadia reported a net income of almost $19 million, $18.98 million to be exact. Fast forward to Q1 2026, and that profit has effectively collapsed down to just $3.6 million. That is a drastic, completely unexpected drop for a company that's been consistently scaling up its commercial operations.
Naturally, the reaction from analysts was swift. The investment research firm Simply Wall Street really hit the nail on the head, noting, and I quote, "Statutory earnings per share are forecast to plummet 49%, so there's definitely been a decline in sentiment after the latest results." They actually point out that right before this earnings release, analysts were anticipating earnings per share of 89 cents for 2026. Now, those forecasts have been slashed to just 79 cents. So the narrative stakes here are incredibly high. A drop like this naturally leads us to ask, is the business model fundamentally breaking, or is this just a temporary blip on the radar?
Section 2. Diving into the financials. Revenue up, income down?
To solve the mystery of this earnings paradox, we need to look under the hood. And here is where things get really interesting. Total revenues actually went up. They climbed from $244.3 million in Q1 2025 to $268 million in Q1 2026. So they're selling more drugs and bringing in more money. But look at their selling, general, and administrative expenses, the SG&A. It jumped massively from $126.3 million to $171 million. That escalating cost entirely swallowed up the profits generated by their revenue growth.
Now, what's absolutely crucial about this, if we ground our analysis in the official SEC 10Q document, is seeing exactly where those costs spiked. Notice that their cost of goods sold is incredibly low. It's just $11.6 million against that $268 million in revenue. That's fantastic. Even their research and development actually went down slightly compared to 2025. So the culprit is entirely isolated in that SG&A line. This tells us they are spending heavily on commercialization, on marketing, and building the administrative infrastructure required to sell their specialty products.
But hey, before anyone sounds the alarm bells, we have to talk about the balance sheet. Despite the earnings miss, Acadia is sitting on a staggering $851.5 million safety net in cash, cash equivalents, and investment securities as of March 2026. Actually, that's an increase from the end of 2025. And that's driven by the fact that their operating activities still provided $34 million in positive cash flow for the quarter. This really emphasizes their underlying financial resilience. They've got the deep pockets required to absorb an earnings shock while continuing to invest heavily in their growth.
To really grasp how they maintain that kind of financial firepower despite such high administrative costs, we have to understand their business model. Acadia uses a specialty pharmacy distribution model. Think of it like a high-end boutique versus a wholesale warehouse. Instead of selling millions of cheap pills at a local retail pharmacy, they sell a lower volume of highly targeted, specialized therapies at a premium price. This orphan drug pricing model allows management to target gross margins north of 80% on product sales. The drugs themselves cost very little to actually manufacture, but they require significant, highly specialized sales forces and super close clinician engagement to sell. And that perfectly explains the high SG&A costs we just saw.
Section 3. The twin product pillars. Defending the revenue.
So let's shift our focus to the actual products Acadia is selling to generate what was over $950 million in annual revenue in 2025. What exactly is funding this whole operation? Well, it relies on two main pillars. First is Nuplazid, known generically as pimavanserin. This is their legacy drug, approved for Parkinson's disease psychosis, and it currently makes up about 70% of their product sales. It brought in nearly $167 million just in Q1 2026 alone. On the other side is their newer, rapidly scaling drug, Daybue, or trofinetide, which treats Rett syndrome. Daybue brought in over $101 million in Q1, showing really strong growth from the previous year. Together, these two specialized therapeutics form the absolute commercial foundation of the company.
And this brilliantly illustrates the power of Acadia's strategy in the rare disease space. Dapu has already captured roughly 80% of the addressable market for Rett syndrome. 80%! That is a remarkably dominant market share, forming a formidable product moat in a very niche specialized space. It essentially proves that their commercialization engine works, even if it is currently pretty expensive to run.
Section 4. The competitive landscape. Threats on the horizon.
Of course, an 80% market share and a profitable moat will always attract competitors. Let's look at the threats Acadia faces in the highly contested central nervous system market, and they are incredibly varied. First, you have the massive pharma conglomerates like AstraZeneca. Their older, generic antipsychotics like Seroquel are often used off-label as a low-cost competitor for Parkinson's psychosis. Now, they do carry black box risks that Acadia uses to defend Nuplazide's premium pricing, but it's a threat nonetheless. Then, in the rare disease space, you have innovators like Taysha Gene Therapies. Their TSHA-102 treatment, which is currently in trials, could offer a one-and-done gene therapy for Rett syndrome. That would directly challenge Acadia's chronic dosing model for Daybue. Furthermore, you've got companies like Neumora Therapeutics bringing AI-driven drug targets to market faster than ever, and rivals like Neurocrine fiercely competing for neurologist attention with their own movement disorder drug. Add to all of this the aggressive mergers and acquisitions environment we're seeing in 2026. This puts intense balance sheet pressure on the entire industry. Because of Acadia's strong cash position and their dominant market share, they find themselves in a really unique spot. They are both a potential acquirer looking to buy complementary CNS assets and an incredibly attractive target for big pharma companies looking to just swallow up a ready-made neurology portfolio.
Section 5. The long-term macro outlook, aging populations and expanding markets.
Let's move to the macro level and see how this builds over the coming years. In 2026, the industry is already grappling with the Inflation Reduction Act's Medicare price negotiations and the rapid adoption of AI and R&D. But looking out over the next decade, there is a massive secular tailwind. Global aging trends project a roughly 25% increase in neurodegenerative disease prevalence. The total addressable market is just expanding naturally. And most critically, if Acadia can secure a label expansion for pimavanserin into Alzheimer's disease psychosis by 2028, analysts suggest it could roughly triple their total addressable market. I mean, that is a massive growth runway.
So we arrive at the ultimate question for anyone watching this space. As an impartial observer, how do you weigh these scales? Because on the bear side, you've got plummeting Q1 earnings per share, massive administrative costs, and looming threats from gene therapies and off-label generics. But on the bull side, you have an 80% market share in a rare disease, over $850 million in cash, and a demographic wave of aging populations that could literally triple their market size in just a few years.
The data from Q1 2026 paints a picture of a company spending heavily to secure its fortress. They seem perfectly willing to sacrifice short-term net income to capture long-term market dominance. But in the incredibly fast-moving world of biotech and CNS therapeutics, is a cash-rich moat going to be enough to hold off the AI and gene therapy innovators of tomorrow? What is your conclusion? Thank you so much for joining me for this explainer. Keep analyzing the data, and I will see you next time.